What if I told you the same chart pattern that showed up right before silver's most explosive moves in history has just appeared again, and almost nobody is paying attention? A single candle just lit up that quietly signals panic, desperation, and opportunity all at once. Miss this moment, and you may spend the next decade explaining why you watched it happen and did nothing. Silver has always been the market that moves last and moves hardest. It stays boring just long enough to shake out everyone who doesn't belong. Then, without warning, it erupts. That eruption almost never starts with headlines or hype. It starts with a single violent move on the chart. Traders call it a God candle, not because it's mystical, but because once it appears, the market never behaves the same way again. That is exactly what just printed on silver's higher timeframes. And if you understand what this means, the idea of turning $100 into $500 in 30 days stops sounding crazy and starts sounding conservative. To understand why this matters, you have to understand silver's personality. Silver is not gold. Gold moves when investors feel cautious. Silver moves when the system feels stressed. It is an industrial metal, a monetary metal, and a speculative instrument all rolled into one. When money starts sloshing around too fast, when supply chains tighten, when currencies wobble, silver reacts violently. Historically, its biggest rallies didn't start when everyone was bullish. They started when positioning was wrong, when traders were leaning the wrong way, and when the chart suddenly forced them to flip. That's what a God candle does. It is a single price move so large, so aggressive, that it invalidates weeks or months of previous trading in one session. It rips through resistance like it doesn't exist. It traps short sellers instantly, and most importantly, it changes market psychology. After a candle like that, dips stop being selling opportunities and start becoming panic entries. You don't need to predict the future when you see one. You just need to recognize that the game has changed. Right now, silver has been sitting under pressure for months. Every rally was sold. Every breakout attempt failed. Sentiment quietly collapsed. Retail traders lost interest. Analysts stopped talking about it. Meanwhile, something else was happening under the surface. Physical demand kept rising. Industrial usage kept growing. Supply remained tight. Paper markets pushed price down, but the real world refused to cooperate. This is exactly the environment where silver has historically exploded. Then the candle appeared, not a small bounce, not a polite green day. A decisive, full-bodied move that erased multiple resistance levels in one sweep. Volume surged. Momentum indicators snapped upward. Long-term downtrend structures cracked. This is the type of candle that algorithms are forced to respect and discretionary traders are forced to chase. It's the candle that tells you smart money just repositioned. Now here's where most people get confused. They see a big move and assume it's already too late. In silver, that assumption has been wrong again and again. Silver does not move in small steps. It moves in waves. The first wave is violent but short. The second wave is where the money is made. That second wave is driven by short covering, new speculative inflows, and delayed recognition from institutions that can't move fast. That's where a small account can grow fast, because percentage moves in silver options, leveraged ETFs, and miners can be brutal. The idea of turning $100 into $500 isn't about blind gambling. It's about volatility expansion. When silver wakes up, it doesn't give you 10%. It gives you 30, 40, sometimes more in days. Instruments tied to silver amplify that move. The key is timing, and timing is exactly what a God candle provides. It tells you volatility has shifted regimes. What worked yesterday no longer works today. Zoom out and look at history. In 2010, silver printed a similar structure before running hundreds of percent. In early 2020, after the COVID crash, silver gave a textbook God candle that preceded one of the fastest rallies in its modern history. Each time, the market looked calm just before it wasn't. Each time, the biggest gains came after the initial shock, not before it. Right now, macro conditions are lining up in a way silver loves. Real yields are unstable. Debt levels are impossible to ignore. Industrial demand from energy transition technologies continues to grow. At the same time, investors are searching for assets that haven't already been inflated beyond recognition. Silver sits in that rare spot where it is still relatively cheap, deeply hated, and structurally important. That combination doesn't last. If you are waiting for certainty, you will get it at much higher prices. The market never rewards comfort. It rewards preparation. The God candle is not a guarantee, but it is a warning. It warns short sellers that their window is closing. It warns sidelined investors that they may soon be forced to chase. And it warns anyone paying attention that the next 30 days may look nothing like the last 30. This is not about hype, it's about recognizing a shift when it happens, not after the headlines catch up. Silver doesn't ring a bell at the bottom, it flashes a signal on the chart and moves on. That signal just flashed, and what happens next will separate those who act from those who explain later why they didn't act now. The question becomes how these moves actually translate into real money in such a short window of time, because this is where most people either get it completely right or completely wrong. Silver is not a buy it and forget it asset when it enters this phase. It is a timing asset, a momentum asset, a volatility asset, and understanding that difference is what turns a small account into something meaningful instead of just another blown trade. When a God candle appears, it tells you one thing very clearly. The balance of power has shifted. Sellers who controlled the market are suddenly on the defensive. Short positions that were comfortable yesterday are underwater today. And when that happens, the market starts feeding on itself. Shorts are forced to cover. Covering creates buying pressure. That buying pressure pushes price higher, which forces more covering. This is how silver goes vertical. Not slowly, not politely, violently. Now layer leverage on top of that. Not reckless leverage, but smart exposure. Silver-linked instruments are designed to magnify movement. When silver moves 5%, certain vehicles don't move 5%. They move 15, 20, sometimes more. That is how small capital can grow fast without needing unrealistic price targets. You don't need silver to double, you need momentum to expand. And momentum expansion is exactly what follows a structural breakout. What most traders miss is that the first pullback after a God candle is often the opportunity, not the danger. The market pauses. Early buyers take profits. Late sellers try one last push, but the structure has already changed. Support forms where resistance used to be. This is where disciplined entries matter. This is where risk becomes definable. When risk is defined and upside is open-ended, asymmetry appears. That's when a $100 idea can reasonably aim for 500. Psychology plays a massive role here. Think about the traders who shorted silver during the long grind lower. They were rewarded for months. Every rally failed, every bounce rolled over. Then suddenly, in one session, months of profits are threatened. They don't calmly reassess, they react. Humans always do. That reaction is fuel. The market doesn't care about fairness, it only cares about positioning. At the same time, sidelined investors start noticing. They hear silver mentioned again, they see it trending. They check the chart and feel that familiar regret. I should have bought lower. That regret turns into action when price refuses to come back down. FOMO is not a meme in silver. It is a historical driver. When it kicks in hard. There is also a mechanical aspect many people ignore. Large funds and algorithms are not discretionary thinkers. They respond to signals. Breakouts above key levels trigger automatic buying. Volatility expansion triggers rebalancing. Momentum models flip from short to long. None of this is emotional. It is programmed. And once those programs turn on, they don't stop because someone on social media says silver is overbought. This is why timing around a God candle matters more than any prediction. You are not guessing where silver will be in a year. You are identifying a short-term window where probabilities are skewed, where speed matters, where patience beforehand is rewarded with decisiveness now. Of course, risk still exists. Silver is famous for shaking people out. That is why position sizing matters. That is why you don't bet the farm. The goal is not to be right at all costs. The goal is to participate in a move that, if it plays out, pays many times what it risks. That is the mindset professionals use. Not hope, not fear. Structure. What makes this moment especially interesting is how quiet it still is. There is no mainstream excitement yet, no magazine covers, no daily hype. That silence is often the final calm before silver reminds everyone why it has terrified traders for decades. When it moves, it humiliates disbelief. If the pattern holds, the next phase is acceleration. Price moves faster than expected, pullbacks become shallow, volatility increases. That is when gains compound quickly. And that is when most people finally notice, usually too late. The God candle is the opening act, not the climax. And if you think this sounds dramatic, remember this is silver, a market that has repeatedly delivered life-changing moves in compressed timeframes, a market that punishes hesitation and rewards preparation. The chart is not promising comfort, it is offering opportunity, and those two things never show up together. And that is the uncomfortable truth most people avoid. Opportunity rarely feels safe when it actually matters. By the time it feels obvious, the risk-reward is usually gone. Silver is once again sitting in that narrow window where uncertainty is high, conviction is low, and potential is asymmetric. That window does not stay open for long. Here is what typically happens next if this structure continues to play out. Price consolidates briefly above the breakout zone, The market tests belief, it tries to shake out weak hands, headlines remain mixed, analysts argue, bears call it a fake move, bulls hesitate because they missed the bottom. Then, suddenly, another expansion hits, another aggressive push higher. This second leg is usually faster than the first because disbelief turns into urgency. This is where returns compress into days, not months. This is where a small position can outperform a perfectly researched long-term investment simply because volatility is doing the heavy lifting. You are not relying on earnings growth or macro reports. You are riding forced behavior, forced covering, forced reallocation, forced attention. Think about it from a market mechanics perspective. There is limited physical silver. There is enormous paper exposure. When price starts moving quickly, that imbalance becomes visible. Futures traders scramble. ETFs see inflows. Options pricing explodes. Premiums expand. Even conservative instruments begin to move in ways people are not used to seeing. That is why silver scares institutions. It does not move in a controlled fashion when stress hits. This is also why time matters. The idea of 30 days is not arbitrary. Silver's strongest moves historically happen in bursts. Long periods of frustration followed by sudden release. Waiting too long often means entering when volatility is already priced in. Acting too early means sitting through chop. Acting when the structure shifts is the sweet spot, and that is exactly what this candle represents. Now, does every God candle lead to a moonshot? No. Markets are probabilities, not promises. But when you combine a structural breakout, improving momentum, macro tailwinds, and extreme sentiment imbalance, you get something rare. You get a setup where being early is less dangerous than being late. That is not common, that is not comfortable, but it is powerful. Most people watching this will do nothing. They will wait for confirmation, then more confirmation, then reassurance from someone they trust. By the time they feel confident, price will already be higher, and the narrative will have changed, from skepticism to inevitability. That is how markets always work. The chart moves first, the story comes later. If silver does what it has done so many times before, the next 30 days will not be subtle. They will be emotional, fast, unforgiving. Gains will come quickly, and so will regret for those who ignored the signal. That is why this moment matters, not because it guarantees anything, but because it offers a clear, objective shift that doesn't care about opinions. The God candle is not a prediction. It is a message. It says the market has woken up. It says the balance has changed. It says that what was impossible last month is suddenly on the table. Turning $100 into $500 is not magic. It is simply what happens when volatility, timing, and structure align. Silver never asks for permission before it moves. It never waits for consensus. It punishes doubt and rewards those who respect its nature. Right now, the chart is speaking clearly. A rare signal has appeared, and history suggests it should not be ignored. Whether this becomes a story of action or a story of regret depends on one decision made in silence, before the noise arrives.